A single mistake I made with ETFs cost me $3,400 in 1 year, and I didn't even realize it until I ran the numbers. If you own ETFs, this video could save you real money. I'm going to show you the most common ETF mistakes people make and exact step-by-step fixes you can use today. I'll use real portfolio examples and actual cost calculation. So this isn't theory, it's numbers you can check. And I'll show two portfolios side by side over 10 years, one that makes these mistakes and one that doesn't. The difference surprised me. Before we get into the mistakes, just a quick disclaimer. Nothing in this video is financial advice. Please contact a professional before making any financial decision. Mistake number 1. Not understanding what diversification really means. Most people think, oh, I bought a few ETFs, so I'm automatically diversified. But that's not always true. You have to actually look inside the ETF because some ETFs are way more concentrated than people realize. Let me give you a simple example. Take QQQ, one of the most popular ETFs. People think it's super diversified because it has 100 companies, but more than 50% of the entire fund is just the top 10 tech stocks. So when tech goes up, QQQ flies. But when tech drops, QQQ falls hard because it's basically a tech-heavy basket pretending to be a big diversified fund. Now compare that to VTI, the total U.S. market ETF. VTI owns over 3,700 companies, and the top 10 only make up around 30%. That's a massive difference. So you can see that one is massively concentrated and one is actually diversified. Here's another thing people don't talk about: geographic diversification. The S&P 500, funds like VOO or SPY, are 100% American companies. If you only own US ETFs, your whole portfolio is tied to one country. No Europe, no Asia, no emerging markets, nothing else. And most beginners don't even realize that. And here's a sneaky mistake almost everyone makes: overlap. If you own VOO, QQQ, and VGT, you're basically buying Apple 3 times. Same with Microsoft, same with Nvidia. Your portfolio might look diversified, but on the inside, it's the same companies repeated over and over. So what's the actionable step? First, always check the ETF's fact sheet. Just search the ETF name on ETF.com or go to the issuer's website. Look at two things: the top 10 holdings and the percentage they make up. If the top 10 is over 40%, that ETF is concentrated, not broad. Second, check your overlap. Use a simple tool like etfrc.com or any free overlap checker. Type in 2 ETFs and see whether you're doubling or tripling the same stocks. Do these 2 steps, and you'll avoid one of the biggest ETF mistakes that quietly mess up people's portfolios. Mistake number 2, treating ETFs like savings accounts. A lot of people buy ETFs and expect them to behave like savings accounts: slow, steady, and safe. But ETFs that track the stock market can drop hard. And if you're not ready for that, you're going to panic sell at the worst time. Let's look at real history for a second. In 2008, the market dropped almost 50%. In the 2020 COVID crash, the market fell 34% in just 5 weeks, one of the fastest crashes ever. And in 2022, even broad boring index funds dropped around 25%. This is normal. This is what the stock market does. ETFs are not savings accounts. So what's the fix? Use something called the sleep test. Ask yourself, if my investments drop 20 to 30%, would I freak out? If the answer is yes, you probably have too much in stocks. A simple guideline many people use is 120 minus your age is the percentage of your money that should be in stocks. The rest can go into safer assets that don't swing as wildly. Now here's something people don't talk about. Volatility isn't just risk, it's opportunity. If you keep some cash or safer assets on the side, you can buy more when the market drops. For example, someone who invested $10,000 every month during the 2008-2009 crash ended up with way more shares and a much higher return than someone who invested the same amount during a calm market. Crashes actually speed up wealth building if you stay consistent. Bottom line, treat ETFs like long-term investments and give yourself a plan you can actually sleep with. Mistake number 3, death by 1,000 cuts, ignoring hidden costs. One of the most overlooked ETF mistakes is ignoring all the small costs that silently drain your returns. None of them look big on their own, but over years and years, they add up to a massive difference. Let's start with fees, because this is where most people lose money without realizing it. Passive index ETFs, like VU or VTI, usually charge something tiny like 0.03%. That's basically nothing. But once you move into actively managed ETFs, fees jump to around 0.50% to 1.50%. It doesn't sound scary, but here's the real math. A 0.75% fee on a $100,000 portfolio over 30 years can cost you more than $67,000 in lost returns. Not in fees, in growth you never get. That's the real danger. Compounding works for you, and fees compound against you. But fees aren't the only hidden cost. There's also trading cost, which almost nobody talks about. Every ETF has a bid-ask spread, the small gap between what buyers pay and sellers accept. Big, broad ETFs have tiny spreads, but niche or low-volume ones can be 0.30% or more. That means you lose money each time you trade, simply because the ETF isn't very liquid. And if it trades far from its NAV, you might even be paying a hidden premium. And then there's the big one. Tax inefficiency. Some ETFs, like covered call funds, pay monthly income that's taxed at a higher rate. Active ETFs also trigger more taxable events because they trade frequently. Take JEPI, for example. Most of its payouts are ordinary income, which gets taxed higher. A simple index ETF mostly pays qualified dividends, which are taxed lower. The gap is huge, but most investors never notice it. So what's the smart way to avoid these hidden costs? First, always check the expense ratio. You can see it instantly on Morningstar or ETF.com. Second, avoid unnecessary trading. The less often you trade, the less you pay in spreads and potential premiums. And finally, be strategic with taxes. Put tax-inefficient ETFs, like covered call funds or high turnover funds, in accounts like a 401k or IRA. Keep your simple, broad index funds in your regular taxable accounts. When you clean up these hidden costs, your returns compound better. And that's how you keep more of your money working for you instead of leaking out through small cracks. Mistake number 4, tracking error. When your ETF isn't tracking what you think. This is simply the difference between how much the ETF returns versus how much the index it's supposed to follow returns. If the index makes 10% and your ETF makes 9.4%, that 0.6% gap is the tracking error. Now, a tiny difference is normal. Anything under 0.10% is excellent. But when you start seeing gaps of 0.50% or more, that's a sign you need to dig deeper, because the ETF may not be tracking the index well. Why does this even happen? Sometimes it's because of sampling. Instead of buying every single stock in the index, the ETF only buys a representative subset. It works most of the time, but it can drift from the index during volatile periods. Other times, it's because the ETF holds a little bit of cash, maybe for redemptions or trading, and that cash isn't growing like the rest of the market. That's called cash drag. Some ETFs actually make money through securities lending, where they lend stocks to institutions. That extra income can help them track the index better, sometimes even beating it slightly. So how do you check all this? It's easy. Go to ETF.com, look up your ETF, and check the Efficiency tab. There's a section called Tracking Difference that shows exactly how well the fund mirrors its index. You can also compare ETFs that track the same index. Mistake number 5, performance chasing. This is one of the most dangerous ETF mistakes, buying whatever is hot right now because it feels like you're missing out. This comes from pure FOMO. When something shoots up, our brains think, if I don't buy it now, I'll miss the chance. But in investing, what just went up often comes right back down. There's a simple idea in investing called mean reversion. It means top performers rarely stay top performers. They usually cool off, and the ones that were struggling often bounce back. So if you're always buying last year's winners, you're basically running on a treadmill. Lots of movement, no progress. Look at real examples. In 2020, ARC Innovation, ARKK, went up more than 150% in a single year. Everyone piled in. But over the next 2 years, it fell almost 75%. Most of the people who bought it during the hype lost money because they were chasing performance, not following a plan. Or take sectors. Energy was the best performing sector in 2022, up about 59%. The very next year, it was one of the worst, down around 5%. That's how fast things flip. So what's the fix? Instead of looking at the last 1 or 2 years, focus on 10-plus-year track records, the numbers that show how an ETF performs across different markets. Morningstar ratings can help too. Funds with 3 to 5 stars generally have strong long-term, risk-adjusted performance. And before you buy anything, ask yourself one simple question. Does this ETF actually fit my strategy, or am I just chasing what's trending? Here's a framework that makes this easy. The 3-factor check. Does it match my time horizon? Short-term hype rarely matches long-term goals. Does it fill a gap in my portfolio? If you already have heavy tech exposure, you probably don't need more. And do I actually understand what it holds? If the answer is no, don't buy it. If you follow these 3 checks, you'll stop treating investing like a casino and start building a portfolio that actually works. Mistake number 6, portfolio plan. A lot of investors don't actually build portfolios, they collect them. They buy VU because someone recommended it, then Triple Q because it was trending, then VGT because tech was hot, then SCHD for dividends, and maybe ARKK for excitement. Before they know it, their portfolio is just a random pile of ETFs with tons of overlap, basically owning the same companies 3 or 4 times without any real strategy. So how do you fix this? Use something called the core satellite approach. It's simple and it works. Your core, around 70 to 80% of your money, goes into broad, stable index funds like VTI for total US stocks and VIXIS for international stocks. Then your satellite, the remaining 20 to 30%, is where you add your tactical choices, maybe a sector ETF, a dividend ETF, or something you personally believe in. This gives you structure while still letting you customize. If that feels complicated, you can also follow the classic 3-fund portfolio: US stocks, international stocks, and bonds. That's it. Once you have a plan, every ETF has a purpose, and your portfolio finally starts working as a team instead of a random collection of shiny objects. And if you want to know how to build the perfect retirement portfolio, make sure to watch this video next. I'm sure it's going to be super helpful.